I see it all the time. That's not true. I don't see it all the time. I just saw it yesterday. I'm doing a tax return on a client. The structure is as follows. Follow me. They have a 1065, which is a partnership. That's the main business. It's owned personally by the main partner, and then it's also a percentage of it is owned by the S Corp, and they flow through certain management fees to the S Corp. All good, right? In 2023, this partnership took their property and they did a cost segregation study. What that is they carved up the assets into shorter lifespan and they took bonus depreciation. Now this was because they added the property years ago, but they never did a cost segregation study, so that was during the years when 100% bonus depreciation was still good. They did a section 481A adjustment, $4 million loss, everything's great. If they didn't have that cost segregation study done, they would have had $400,000 of income from the partnership. And guess what? When you are active in your business and it's a partnership, there's Social Security taxes on your income, right? But because they did this cost segregation study, they made that $4 million loss offset the $400,000 income, self-employment income, and there was no SE tax, no self-employment tax for 2023. And then they have this big NOL, which was done on purpose because they know that in the future they're going to be profitable. Okay? Everything's following, everyone following. Okay. Come 2024, the business has a net profit of $400,000 once again. Pretty similar to the prior year. Some of the income was shifted to the S Corp, and they did their payroll there and their management fee and their managing companies and all their other stuff in the S Corp. The S Corp usually is just a net break even. Fine, everyone's cool with that. But the partnership has a K1 flowing through to the personal owner, and now there's $400,000 of SC taxable income. And through the planning, and the prior accountant thought or didn't really think that, hey, listen, we have this big NOL. This guy's not going to pay taxes for a bunch of years now, assuming that he makes $400,000 every year. And they are 100% right. They're not going to pay any income tax because they have an NOL. Not 100% even so right, because NOLs, if everyone paying attention, is limited to 80% of your profits that year. So only 80% of your NOLs can you use. So you will still have some taxable income. And in 2024, they're $400,000, 80% of the 400,000. So they have about a 350,000, let's just make it up, of NOLs. So they're still going to have $50,000 of taxable income, right? What wasn't thought about was SE tax doesn't go away just because you have losses from a prior year, active losses. They still were subjected to $400,000 of SE taxable income. And guess what? Now they have a big bill. The year before, they had a big overpayment. They refunded the whole thing to the client, to the taxpayer, because they figured you got this NOL, nothing to think about. You're not going to pay taxes. Well, guess what? SE taxes is something that's going to still be there. It's kind of similar to if you're having the same situation and you're only using S Corp. Yes, you still have to do a reasonable salary and pay some Social Security tax, even though you have an NOL from a prior year. And be careful when you're doing planning for your clients, when you are doing planning for yourself, if you're the taxpayer, that NOLs are great. They have this limitation, so you got to always account for that. It used to be you could take 100%. Since 2017, you can only take 80% of your current year income to be able to offset with those NOLs. And have a great day. It's a great example of just missing the boat.